We bring you news and analysis every day on the Bloomberg Surveillance Podcast. But now you can get the latest news on demand whenever you want. Subscribe to Bloomberg News Now to get the latest headlines at the click of a button. Get informed on your schedule. You can listen and subscribe to Bloomberg News Now on the Bloomberg Business app, Bloomberg.com, plus Apple, Spotify, and anywhere else you get your podcasts. Search Bloomberg News Now and subscribe today. This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jon Ferro and Lisa Abramowicz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts, and always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app. This is without the question for this week, the interview for those of you on radio and television worldwide who are saying, forget the fancy talk common sense. Robert Dahl has decades of experience enjoying losses in the equity markets. He's at Crossmark Global Investments and is a needed conversation this morning. I want you to address the retirees, the institutions who are very 40 within the 60-40 split. You and I have never witnessed price declines in bonds like this. What is the to-do for the people that have been hammered in bonds?
As you know, if we don't get a nice rally in the bond market in the fourth quarter, it'll be the third year of losses for a 10-year Treasury. That has never happened before in history. So these people are sticker shock, shell shock, whatever the word is.
Do they shift to equities?
Look, depends on your time horizon. If you have a long time horizon, you're 65 and you're retiring and you're good health, you should have more equities.
See, always looking at me when he says that.
Well, you say, do you shift to equities? Let's dig deeper into that. Do you realise these losses in the bond market? That's essentially the question Tom's asking here. Or do you sit on them?
Yeah, so I don't think you run for the hills in the bond market. I don't think we've seen the high end yield. Look, you've been debating why are yields up. They're up because the economy's a little better than expected. Inflation's nowhere close to 2 and is stubborn. And you got the supply-demand thing that rears its ugly head every once in a while. That's not an environment to see a 3 handle on a 10-year Treasury.
And right now we're wondering whether bank earnings are indicative of the broader economy or whether they're an outlier at a time where they're consolidating their business in a smaller number of high-income individuals. What's your view? How much of a tell has the early earnings report been?
That's a great point you're making. That is to say, bank earnings are probably a little less useful than usual, a little less useful for overall earnings. Look, my big surprise, you touched on it a second ago, is we haven't seen more consolidation in the banking industry. Post the debacle in April, my thought was we're going to see more bank combinations, and there've been precious few. There will be more to come. We need fewer banks.
At this point, though, given the fact that you're still seeing credit extended in the economy, do you think, to put these two ideas together with the bond market, that bond yields could go even higher on the long end and that actually Meghan Graper is correct and the bond market is telling the Fed they need to do more on the front end and not that they have to let the long end do the work?
I agree with you. Is the long end doing some of the Fed's work for them? Absolutely, but that's proving not to be enough. The Fed, I don't believe, is done. We said all along, either November or December. I think it's more likely December. But I still want to come to the point, more important than if the Fed raises rates again, is what about the impact from 0 to 5.25 in the last 18 months? We have not seen the full impact of that, Lisa, and I think that's still in front of us.
Let's talk about the banks and build on the way Tom started this conversation. Many of these banks are sitting on some securities, very long dated, bought when rates were very low. Now rates are higher. They're underwater.
By a lot of money.
This is what Bank of America and the CFO is saying about them. Expect 0 losses from the held-to-maturity securities. I think we all understand that. What gets them out of the penalty box regarding this story? Because that stock has been bullied by this story all year.
Yeah, because they're big numbers and it's legitimate. Some banks had a mark-to-market, and we know what happened back in April. Look, these things will mature, and they'll be at a 0 loss at that point in time. But it's so big and it's so pervasive. I don't know how you can hide behind that and ignore it.
To your brilliant question, John, I'm sorry, you're 100% correct. The idea of held to maturity is BS in any textbook. You go to Lehigh University a million years ago, and young Dahl was going, that's That's baloney. Let's talk real baloney here. I want to talk about your CPA background and the fancy Wharton degree you've got, which is about accounting. The absolute shock of the gloom crew has been margin resiliency. That's an IMF term. Everybody's resilient. I was resilient over my Moroccan coffee. Are we resilient right now on our margins?
I don't think so.
You're going to see margins give way.
I think margins will come under some pressure. We're early in the reporting season, and they've held up reasonably well. But I don't see how companies can continue with these big price increases to match their cost increase. Look at the labor wage gains.
Okay, so are you in cash? I mean, this is the negative. This is the gloomy doll we're seeing today.
We have more defensive securities. I want securities, stocks, that have high earnings predictability, high earnings persistence, good cash flow, and reasonable valuations. And that means you're away from the economy to some degree.
That's Apple, Microsoft, and Manchester United.
Okay. Manchester United.
What are the names, Bob?
Those would fit the bill.
Not Manchester United.
Yeah, definitely. I double up on Manchester
right,
United. The HMOs fit the bill. Some software companies fit that bill. It's what are the companies that you're pretty sure 6 months from now will deliver the earnings that are expected? I think a lot of companies will miss on earnings as the economy slows. Whether we get a recession or not, that's escaped almost everybody's vocabulary. I don't think it's out of the picture for next year.
Walmart, present PE, almost a 30 multiple. I don't get it.
How many times this year have we heard about a weaker consumer?
All
How
year?
many times? We've
All
said
year?
on this program, the economist that cried recession. Do you see it actually materializing this quarter? What are the sources of demand that's held up this economy that you can identify that are failing currently?
So the amount of cash on the balance sheets, the excess cash from the pandemic, that has definitely come down. We can debate whether it's almost over or still $500 billion or whatever, but it's not $3.5 trillion where it was. Two, we're starting to see fewer people work multiple jobs, and that's often a lead indicator into the job market. It's not a long list at this point. You have to look at the lead indicators for the employment cycle. And they are getting to the point now where 18, 24 months after the Fed starts raising rates, after the yield curve begins to invert, we just have no patience. Somebody went back and looked at these periods in the past between Fed raising rates, yield curve inverting, and the start of a recession. The dialogue is always, the recession, it's never coming. And then all of a sudden, there it is.
Jobless claims, coincidental indicator, saying it's not here, isn't it?
No, it's not here yet. That's correct.
Still in and around 200K.
Greg Daco joins us now. Chief Economist, EY, as he considers this across all the advantages of the EY system. The market was surprised. Were you?
Yes, I think the surprise was both in terms of the strength of the data in September, but also, as you mentioned, the upward revision for the month of August. We are seeing that consumers spent more than we initially thought over the course of the summer. The key question is twofold. One, do we see that momentum persist into the fourth quarter, or do we see a little bit of a pullback after the strong summer? Two, is it inflationary growth? To your question about whether the Fed will have to go further in terms of raising rates. So far, we haven't seen the type of inflationary dynamics that would be aligned with this strong growth. I think that would allow the Fed to not necessarily have to tighten further.
Are we in the thrall still of pandemic uncertainty? Do you have a belief to Q4? Can you model out Q1, Q2 of 2024? Or are you just making it up because this is a regional macroeconomics?
Well, I think it's very difficult, certainly, to forecast in the current environment. We have a set of unique features when it comes to the state of the labor market. We have a set of unique features when it comes to the state of the housing market. When it comes to the resilience of consumers, even, we've been surprised as to how resilient consumers are. But I would note a few things. First, we are seeing the drag from higher prices weighing on consumers' ability to spend as we move forward, especially for lower income families. We're seeing the weight of higher interest rates weighing on people's ability and desire to spend on credit. We're seeing tightening credit conditions, and we are seeing the effect of tighter financial conditions even today.
Okay, this is what people have been saying. Fed officials included in anecdotal conversations that they've been having with their constituents. They're hearing about this. So then why does the data keep coming in stronger than expected, read after read?
Well, again, this is still the third quarter, right? We had a strong third quarter. We know the spending in terms of consumer activity was very strong in the third quarter. We also know we're not seeing a retrenchment. That is one of the key elements of this economy. We're not seeing the business sector retrench, whether it's in terms of investment or hiring. That is still supportive of income, and in turn, that has allowed consumers to spend. The key question is whether this type of momentum, very strong momentum in the third quarter, can really persist into the fourth and into the first of next year.
You said something that was really important, that it's unclear whether this type of spending is inflationary.
Yes.
What is going to be the tell on that? Because it seems like if people are willing to pay higher prices and companies are passing them along, akin to Pepsi or Coke, and we've got shrinkflation and all that, well, why wouldn't this be inflationary? Why would inflation keep dropping?
Well, we've continued to see slower momentum when it comes to CPI prices. When it comes to PPI prices, even the margins on the PPI front are pointing to less inflation on a sequential momentum basis. Even the jobs report last Friday, that was very strong, was non-inflationary. We were seeing the help from the supply side help alleviate some of the wage pressures and bring down wage growth. So that's less inflationary than would be concerning for the Fed. And we've seen actually inflation run ahead of the Fed's expectations. I wouldn't be surprised that we end up below the Fed's SEP projections in terms of inflation by year end.
Greg Daco of EY, where this will continue here, 5.15% in the 2-year. The 10-year yield really buttressed out right to recent highs, 4.80%. 30-year bond a dash to 5%, 4.94%. Michael McKee, a further observation.
Well, I think the auto sales is an interesting situation, and we don't know how much of that is parts and repairs. But given the fact that we had a strike, and maybe that got people to go buy cars while they thought they could. But at 9:15 this morning Eastern, we get the industrial production numbers, and we'll see about auto manufacturing and see if that is a sort of counterweight to the auto sales. If we're just selling what's on the lot and you're not going to have any more, then that is less of a problem for the Fed. But it's an interesting dynamic.
Yeah, but Mike, for 4 years, we've simply misguessed the resiliency of the consumer. What are the economists doing wrong?
It's an interesting question, because we always used to say before the pandemic, never stand between an American and a cash register. And that seems to be back in force. There was a shift in spending. Everybody went to goods during the pandemic, and then everybody did revenge travel and went to services. And now it seems to be broadening out so that people are just continuing to spend. But we thought that their money would run out, and it hasn't. It may be the additional wage gains that people have gotten, because people tend to spend what they make. And now if we've spent down the pandemic bonuses, it may be that people got raises and they feel like they can spend more.
Greg, just final word here. Does that mean that this world can live with 5% benchmark rates, and that we're looking at a new term structure that looks very different to what it did 3 years ago?
Well, we certainly have to adapt to a higher cost of capital. I think there's no doubt that we have to have both the business sector and the consumer sector adapt to this higher cost of capital. I would point to one thing that is very important in this higher cost of capital environment: how strong income is. If we start to see softening in income, which we have seen, that will weigh on people's ability to spend. But there's no doubt that we're not going back to the free money era. People still want to invest in this environment, but there's going to be more scrutiny as to how much investment goes into the economy and how much hiring goes in.
Road, final quick question. Which matters most, the November meeting, November 1, or do we dash to December? Which meeting is of greater value to Greg Daco?
I think both meetings are going to be quite interesting, because even if we don't get a rate hike at the upcoming November meeting, we'll get a discussion and more information coming out of Fed Chair Powell as to the intentions of the Fed going into the last meeting of the year. They will want to maintain that optionality of one more meeting, but I think they're increasingly taking comfort in the fact that the July rate hike may have been this last rate hike in this historic tightening cycle.
Interesting, Tom. We see the November meeting hasn't changed in terms of futures pricing, 9.8%, but now we're up to 31% for December.
Exactly. I think maybe this is the moment where we launch out to, I believe it's December 13th. Greg Daco, thank you so much.
Thank you.
With EY, Ernst & Young. Natarajan joins us, owns the high ground on the major banks, and particularly Fortress Solomon, or at least Igloo Solomon, as it is. Let me just go to a general and open question right now. Your thoughts? I'm looking at different stories here saying it was a moldy quarter because of the write-downs. But your thoughts, Sri?
Not necessarily because of their pullback from consumer lending. It was a moldy quarter. This is again a transition quarter. We talked about the second quarter for Goldman Sachs being a kitchen sink quarter. They are doing the strategy pivot. They owned up to their mistake with the consumer banking foray and lopped in a lot of the losses and the hits from backing out of that in the second quarter. Some of it is reflected in the third quarter as well, but a lot of the losses are also just straight tied up to the real estate market and also the fact that the investment banking market remains sluggish. That's what's driving profits down 33%. Not necessarily some of the changes you're seeing there. They're significant from a strategy perspective, not necessarily a third quarter earnings perspective for Goldman Sachs.
What is Igloo Solomon, TK?
Smaller.
Oh, okay.
Smaller,
sound
more
like icy,
focused.
cold.
We have
All right, please ask the question. That's what you were going, right?
That and it was melting.
Fortress is like big, and we're doing this, and we're doing this. That's what Jane Fraser wants to do. These guys want to. Can we just get back to what we used to do in a smaller format?
Okay, good to know. Just wanted to play that.
There?
That was
Thank
wonderful.
You. Thank you.
Go on, please.
In my mind, a Fortress is also a lot more sturdy than an Igloo.
Okay, you're both digging, aren't you? Are you saying that things are sturdier at JP Morgan right now than Goldman Sachs?
I was just trying to explain what Tom Keene is saying.
Okay, we're all trying to. I'm making a career out of that.
Save us, John.
Okay, of the forces that have held this bank back, are things getting better or worse?
It's headed in a new direction. Not necessarily better or worse, because they will have to execute. It is a story that they have to tell. They have a coherent story to tell now. You could argue that there was some flip-flopping over the last couple of years, but at least now it's clear. They say they have two important legs to the stool, the investment bank and the asset and wealth management unit. Now the key is to prove that they can deliver on both fronts to the expectations of investors and therefore drive the stock higher with higher multiples down the road.
What can we learn from the fact that Goldman Sachs beat on equity trading revenue at a time when we saw JP Morgan and Citigroup not?
It's interesting. Look, over the last few years, the crown for equity trading champion on Wall Street has been moving around between Goldman Sachs, Morgan Stanley, JP Morgan. It was pre-pandemic, at least for a few years, unquestionably Morgan Stanley. Not so much post-pandemic. That comes down to some credit you have to give to Goldman traders who have gained serious market share across equities and FIC. Bank of America had a big jump in their equity trading business, but that was off a lower base. Goldman's jump from $2.6 billion to $2.9 billion in a quarter is pretty significant. If you can hit $3 billion a quarter in equities, that's a pretty sturdy business.
What's the difference between market share gains and riding a good market, right? A lot of people have raised questions about how robust capital markets are right now, given the fact that a lot of companies are icing a lot of their transactions. How much is this just market share gain from European banks, from smaller banks, from each other, rather than really reflective of a good environment?
Riding the gains is a factor of the overall wallet. An individual bank does not control that. But what they can control is the market share of the wallet that's available. And if you are gaining market share there, you're making progress. So even if the entire industry moves in a certain trend, if you're gaining within that, you will stand out, at least in the eyes of investors.
Sri, not everyone's a bank analyst. There's some people listening to this and hearing phrases like how-to-maturity securities and all of this stuff regarding Bank of America. The stock's in the penalty box. It's down close to 20% year to date. Can you explain what is going on? Those longer-dated securities are underwater. We can all get that far. What's it stopping this bank from being able to do that is punishing this stock so much?
The punishment in the stock simply goes to the fact that because they made that move, because they plowed their excess deposits a couple of years ago into some of these longer-dated securities, that with the moves in interest rates that we've seen have been underwater, has meant that their securities portfolio is down $131 billion. That doesn't affect their earnings, but it does affect their earnings potential. Right? If they had not had this money locked up there, because it's all in held for maturity right now, if they didn't have that money locked up there and earning 2.5%, it could well have been earning 4.5% and 5% in a 5% world.
Okay, this is brilliant. And I got like 8 questions and we don't have time. What is the maturity right now? What is the average maturity of their under $0.1 trillion?
See, this is what I said about trying to decipher Tom Keene. It can be very tricky, and sometimes you just end up without an answer.
What's the average maturity here?
You got me there, Tom.
We don't know. Does Michael Barr know at the Fed?
I'm sure he does.
Oh, why don't we know? I don't understand why shareholders don't know the average maturity of any given bank's held-to-maturity portfolio.
They do break it down. If I pull up the results, I can probably figure out that number for you.
The distinction that Sri's making, Tom, is really important.
Yeah.
This isn't about selling those securities at a loss. It's about earnings potential, which is why I really wanted to break this down. So when they come out and they say things like, we will have no losses realized on these securities, that's kind of meaningless, isn't it? Isn't it just that your earnings potential relative to, say, JP Morgan is that much lower.
If you have a $400 billion securities portfolio, let's make up a number here, $500 billion securities portfolio, and you're earning 2.5% instead of an average of 4.5% on that, that's a 2 percentage point difference, and that's a $10 billion earnings difference. That adds up, and that matters. That's the reason the stock's down 20% this year, was down even more last year, and that's not a good look over a near two-year period.
When it comes to earnings potential, though, we're not talking about extending loans for mortgages. Thomas Show of KBW on earlier saying that they've gotten out of the game pretty much. How much is this just simply being able to capture the differential to current market yields on safe loans to high-income people versus the beta of what you've got to pay to depositors, which is basically nothing?
If they were down 5%, if they were down 8%, and we're talking about how do they get to being down 4% or being flat for the year, that's the latter is what we're talking about. The reason they're down 20%, way worse than every other big US bank out there, is largely down to this earnings potential because they are missing out, plain and simple.
One final question. Does David Solomon have the support of the board? Within your reporting, I give him very high marks for managing this, as you say, kitchen sink over to another quarter, but does he have the support of the board in this process?
We don't have to guess on that front because last month, Mike Mayo was able to extract a public nod of support from the Goldman Sachs board lead director saying he's not going anywhere.
What's Montag doing?
Montag's there digging into numbers and clearly backing David Solomon.
This has felt personal for, I would say, the whole year so far, hasn't it? It's felt personal within the bank. I don't hear complaints from investors like we've heard complaints from sources within the institution.
Undoubtedly, there was dissatisfaction in the ranks. You can't get away from that. Part of it is Goldman screwed up on one front. Goldman Sachs prides itself on excellence and, in fact, risk-taking, and they have very little tolerance for it. But now that you're through the other side, now that you've copped up to your mistake, now the story is, do you then move on, or does the rank and file still demand consequence?
They're trying to move on. Sri, thank you, sir. Sri Natarajan there of Bloomberg on Bank of America and on Goldman Sachs.
Meghan Graper joins us now, global co-head of debt capital markets at Barclays. Meghan, you note the disinversion out there, the yield curve's doing what a yield curve should do. You suggest that extends the timeline for the Fed. How does disinversion change the Fed's timeline into 2024?
Yeah, I mean, I think it's fair to say we've entered a far more complicated phase of this cycle. The market's really now in a daily tug of war with policymakers around the path of rates. And I think there's been a lot of misinterpreted signals this month. I think the real question in my mind is what Powell and other members of the Fed opt to message this week ahead of blackouts in the context of what continues to be a rapidly evolving backdrop. But you've got a strong dose of reality for the market between employment data, CPI, PPI, UMISH. I mean, all of that combined, I think, plays into how markets are responding, particularly on the rate side. But I think we've read far too much into recent Fed speak that implied that these higher rates might have actually done some of the heavy lifting. And what I think the market has failed to take into account is the nuance behind the why. I mean, why are financial conditions tighter? If it's the strength of the economy, which is fueling these longer term interest rates, they may actually need to do more. And I think if you dug into Logan's commentary, he suggested as much.
In your head, what is the level of the 10-year yield where Powell and company are overcome by events? Is it a 5 handle or is it something more subtle than that?
I'm not sure they're really focused on a nominal yield as being the determining factor. I think it's more about financial conditions, tightening of financial conditions, and buying themselves room to continue to evaluate the data.
How much, Meghan, do you see a potential risk to credit as yields go higher and potentially the Fed does more, which, as you think, is your base case?
Yeah, I mean, I don't think we can underestimate how hard it is for risk assets to rally meaningfully here when treasuries are this volatile. And yet we are, with everything going on, seeing a very resilient credit market. I mean, 3-month spread balls at the lowest level since the start of 2022. Spreads on the corporate index are still hovering near the tights at 124. So it's been a strikingly tame backdrop in the face of this elevated rate vol and even with some of the geopolitical overhang. I think as you talk to investors, what we're starting to see is a bit more polarization in terms of how accounts are approaching the market. So there's definitively more discipline being incorporated in terms of investment decisions. If you're total return focused, I think you're waiting for the dust to settle a bit on some of this intraday volatility. If you're yield focused, there's a very attractive entry point here that we continue to see for insurance and pension money in particular.
That's from the investor side, Meghan. One reason why it's wonderful to speak with you is because you also speak with the corporate finance officers, and you understand the angst of paying more than 10% yields, at least if you take a look at some of the market rates for about a third of the high yield index. How much angst do you feel among corporate executives as they look out at their runway and wonder when they're going to have to actually face off with these higher interest payments?
In investment grade, there's a decent amount of complacency talking to both Treasury teams and CFOs as they think about evaluating markets here, in part because there's very functional market activity as and when they do need to come to market. So there's a degree of patience I think we're seeing. We are seeing a backlog build for this post-earnings window, but October has been the quietest start to a month. Going back to April, so when we were dealing with the regional bank volatility. So there's a willingness with very manageable maturity towers for issuers to sit this phase out. I think you're likely to see deal sizes smaller and shorter as a result. Bringing
your debt world over to economics, where is your real yield out 6 months, out a year? We've got a 235 level, 10-year inflation-adjusted yield. Where do you see that out a year, say?
Out a year. I think we're going to be range bound for an extended period of time here. We don't see cuts playing into the equation until at least past September of next year. So a year out, maybe we're seeing some reduction from current levels, but I think we've got a ways to go before we see that play out.
Are we learning, Meghan, that this is a corporate and consumer structure in the U.S. economy that can handle 5% rates for a longer period of time, or have the lags just gotten much, much longer?
In investment grade, I think things are reasonably well insulated. You only have 7% of maturities coming due over the next 12 months, and it's closer to 17. Where we've got greater concerns is probably on the high yield side, where those maturity towers are definitively looming. So looking at both bonds and loans. So I think it's going to be have and have nots as we look at the path ahead.
Hey, Meghan, thanks for being with us. Meghan Graper there of Barclays on the latest with the Fed speak. So much Fed speak this week.
With historical perspective on this, Henrietta Treyz with Veda Partners here on how Washington will respond. Henrietta, to Jon Ferro's point there, it is about aid. Let us go back to 1973, Nixon and Kissinger, and basically they did an airlift to Israel. Does Congress want to support President Biden if an airlift is required to support Israel?
I think they do. I think they're very eager to start taking votes on all kinds of aid, whether that is munitions, extra enforcement of the Iron Dome, anything that the president needs on a military basis. And then there's also a strong desire to provide financial aid. We just heard from your great reporter in Tel Aviv that they're looking for $10 billion on the Israel front. Right. I would not be surprised if when that gets over to Capitol Hill, they try to increase that dollar figure. That's usually what happens as members seek to sort of illustrate their support for the nation.
Henrietta, you are expert on the body language of Capitol Hill. I think of John Huntsman Jr., former governor of Utah. His family has pulled money in the last 24 hours or stopped donations to the University of Pennsylvania over some of the debate and protest there. How are the Congress people that we have, how are they reading the mood of America on this war?
You know, that's a great question. I think the fallout is only beginning there. As right now, we're sort of in the immediate aftermath where there's reticence to come out in opposition to anything that Israel might need right now. But as we get into the days and weeks ahead, I think to echo some of the commentary we heard from former President Bush, there's going to be a loss of interest in this, which I think is very real and borne out by historical realities. And what happens is you start to get factions. Already there are a number of bills targeted at penalizing in some way the Biden administration for the $6 billion from Iran. that's only going to get exacerbated. So I think people are really reticent to voice their fulsome views on where things are with either Gaza and Palestinians, Hamas, or the Israelis, and that will probably foment in the days ahead and get more aggressive.
Unlike Ukraine, do you expect that opposition to come from within his own party, within the president's own party?
I think it's going to come from a whole bunch of different outlets. You have a pretty far right, extreme sort of anti-Semitic component, and then you also have a very far left pro-Palestinian component. And both of those are just going to get louder in the days ahead. And especially as the ground invasion starts, there's a lot of attention on that right now. Obviously, Secretary of State Blinken is heavily focused on containment and making sure this does not escalate. The Biden administration's moved 2 aircraft carriers into the arena right now to try to make sure that that doesn't happen. But that escalation is something to really be mindful of. And I think the extreme positions exist across the political spectrum.
There is also talk about American troops here, Henrietta. I shared this story with our audience in the previous hour. I'll do it again for people just joining us from the Wall Street Journal. According to US defense officials, that the US military has selected roughly 2,000 troops to prepare for a potential deployment, support Israel. The troops are tasked with missions like advising and medical support. Important to point out what they're not there for. They aren't intended to serve in a combat role. No inventory have been put on prepare to deploy order. And this as well, it isn't clear under the circumstances the US would actually deploy the troops or to where. Henrietta, talk to me about support for that in Washington currently.
I don't think support for troop deployment is there, just as we saw with Ukraine. The most fascinating stories come from the sort of personal anecdotes of Americans going over to Israel to sort of volunteer. But I don't think troop deployment is something that this administration is prepared for. As I mentioned before, I think their effort is to contain and prevent escalation that might ultimately require something like troop deployment. We're happy to throw money at the problem. I think there are more than enough votes for that. And indeed, what I've been telling clients is not only are there votes for the funding, but the funding is so popular that it can carry other things like aid to Ukraine, aid to the U.S.-Mexico border, and probably a government shutdown avoiding position. But I don't think troop deployment is something that any member would voluntarily talk to you about right now.
Just quickly, speaking of votes, got to squeeze this in about 20 seconds if we can. Will we have a speaker by the end of the week?
I have no reason to update my priors, to be honest. I mean, they don't have a bill requesting aid to Israel. They don't need a government funding bill until November 17th. I fail to see the urgency.
Henrietta, thank you. Henrietta Treyz there, of Veda Partners on the latest.
Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern. On Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.